In this video, we'll talk about 5 observations that should help make you a better futures trader, especially if you like to trade at the edge. Keep watching to see a breakdown of these 5 patterns. I'm going to start this video out by having a short tribute for a major source of inspiration for both Cody and myself, Mr. Kobe Bean Bryant. I had a chance to visit the Kobe Memorial in front of the Staples Center yesterday, which is truly an incredible sight. Here's some pictures for anyone who's interested. But a quick backstory. So Kobe was a major source of inspiration for both Cody and myself when we started building out TOS indicators. His show Detail, for those of you that have seen it, is why we started making some of these videos, and his meticulous attention to detail and willingness to share this knowledge, and really his lack of fear to challenge the status quo is what inspired us. He was always curious, his work ethic was borderline crazy, and his relentless pursuit to be great made him the Black Mamba. Those are all qualities that we ourselves can strive to embody as traders to become the best damn traders that we can be and work together to help each other learn, grow, and profit. Like many others, we're still in a state of disbelief from the news, but our prayers and well wishes go out to all those affected by the tragedy. Let's use some of this Mamba inspiration by Kobe Bryant and study the charts and pay attention to some of the smaller details in this video. Let's start by taking a look at a chart of the S&P futures, and then we'll take a look at each the Nasdaq, the Dow, the Russell, and I'll show you a grid format so we can see the same patterns, but the S&P is the one we'll focus on. So we have our aggressive volatility box plotted here on a 3-minute chart. So now let's take a look to see how we played this day. So we start by taking a look at that first hour and we check to see whether or not we breached either side's aggressive volatility box entry lines. We did. However, before we stopped out of the clouds, giving us that clue that, hey, price is really starting to breach outside of even our aggressive models, we ended up having an opposite and equal reaction. So this was our first sign that, hey, it's okay to use the aggressive volatility box for the rest of the day. Now our first trade came as we tried to catch this fade right here, and instead of having that nice reversal that we typically see, we ended up getting stopped out almost right away. So this is that first trade. This was a loser, but what ended up happening is we reversed, right? Now this is our first sign once we break outside of our aggressive volatility box models that we should switch on over to our conservative volatility box. So let's go ahead and do that. And at this point, this trade is free information for us. We're checking to see if price action still holds even our conservative volatility box models and then reverses, or if we end up falling straight through. Now in the case of the S&P futures, we did reverse. However, something to keep in mind is for all intents and purposes, we did breach outside of the volatility box clouds. So we knew that the S&P, our volatility, even using our conservative volatility box models, was still exceeding a little bit outside of what we would expect normally. However, this is inside of our buffer zone period. So that was where if you were, say, using only the conservative volatility box, you should have still been spared. Right? And our buffer period is $50 for the full size contract, $5 for the micros. Now, what we ended up seeing after is once we held these conservative volatility box levels, we ended up having a nice V-shaped reversal in the opposite direction. Now here, we also had our edge signals populate. And the edge signals, for those who don't know, is a free indicator that we give to all of our volatility box members, and it's purposely lagging. Its intention is really meant for markets like gold, bonds, crude, the more aggressive markets, and we don't really use it on our indices. However, with the news of the virus hitting the markets, seeing the volatility that we've experienced, they've also proven to be a little bit more useful than not to traders who are, say, looking for a bit more confirmation signals or confidence behind each trade before they actually take it. Right? So this is that first observation is edge signals have added confidence, especially on days of extreme moves, right, in one direction or the other, or like we'll see in Friday's activity in a trending scenario. So that's observation number 1. Now, what we see from here is we then had an opportunity to get short the S&P futures as price slammed into our conservative volatility box. Now, in this case, we did not hold our buffer period, but instead we ended up getting stopped out right here. And what we noticed shortly after that is we had once again a cluster, another observation, of edge signals populate before we ended up having this nice reversal move down after. However, for us, we were stopped out here because we exceeded what we had thought price action would have been in. Now that one hint here that gives you the idea is, hey, we had exceeded the price outside of the volatility box clouds right here as well. And the edge signals really were then your indication to try and get in. And any price better than the cyan dashed line is an opportunity to still participate in the same exact trade, however, this time on the move up, right? Now, if we take a look to see on the opposite side, we still exceeded that volatility box, and then you had your two edge signals populate, and you had an opportunity to get in at a price better than what would have been that first original price instead of getting stopped out like we were. And your hint for that was that, hey, we were exceeding even the conservative volatility box models, and this right here is free information, right? We've already been stopped out on that first aggressive trade. So this right here is free information that you should be able to use without emotion to then help you understand these patterns real time and start to notice them and take advantage of them when you recognize that the market is moving more often than not. Now let's take a look at that third opportunity. And usually for us, this is our sign that, hey, we've exceeded our conservative volatility box. Let's stay out of the market. Clearly, our models aren't holding. For the more aggressive traders, you can then start to use the edge signals. Now let's take a look to see what happens with common patterns, such as a double bottom, which is what this next entry in the volatility box was. So typically, you might be, say, looking to sit on your hands here, or you might also be starting to look at things like the edge signals for a confirmation to get back in. Another pattern that emerged here was the idea of a double bottom, right? We came down, then we chopped straight back up, and now we came back to a very similar area. And this time, our volatility box entry line was overlapping really nicely with what would have been a double bottom signal. So that was really nice to see and could have added more confidence for a reason to participate in this trade, especially when you started to see this cluster of 4 arrows populate. So that's another observation. It's the idea of overlapping of traditional patterns, things like double bottoms, double tops, resistance, support, with the volatility box levels to find nice high probability trades. We're expecting most psychology to already remain true, and you're looking now for a structure to fit your trade. And you'll notice in the case of gold, for example, with Friday's activity, gives you even a nicer entry into a swing trade. Now, before we see what actually ended up happening, let me pull up a grid snapshot of the market at this exact time with all 6 of our futures. So if I bring that in, this is the same exact time. And I ended up capturing a screenshot. Thank you, Ramsey, for that idea. This is that first screenshot idea that we've actually had. But here we have a chart of the micros, and we have the S&P, the NASDAQ, the Dow, the Russell, gold, and crude. We can start to see a very similar pattern here, right? And this is what should start to now appear, especially if you have this grid format, is everything is starting to work in some sort of harmony. It's synchronous with each other, and they're each giving you signals and signs of potential moves to come. Right here in the case of the S&P, we see a cluster of 3 arrows, and this is using our conservative volatility box model. In the case of the NASDAQ futures, we see once again 3 arrows. In the case of the Dow futures, we see only 2 arrows, letting you know very quickly which is stronger really based off of the strength. And this again goes back to that case study we've done on the coronavirus, in which we've seen that the Dow ends up becoming the market that ends up exceeding its relative volatility, which we see here. It came down to the clouds versus the NASDAQ bounced from our cyan line versus the S&P bounced from even above our clouds. We also see that while the NASDAQ and the S&P have 3 arrows, the Dow only has 2. So those patterns, that homework that we've done, the research, continues to keep helping us because this down move was based off of more virus news. In the case of the Russell, something very similar. You see 3 arrows giving you that same strength. And now something very interesting is in the case of gold, we see 3 bearish arrows, right? And this is a pattern, another observation that we're starting to see, which is gold and our indices futures markets have been working together, right? And oftentimes when we've seen the market volatility exceed in the S&P futures, we've seen that the market volatility in gold is far more contained, right? We'll show you what gold looks like on the same Thursday before we move on. But the pattern to keep in mind is while we have 3 clusters here of bullish, 3 clusters here of bullish, 3 clusters here of bullish, 3 clusters on the gold futures of bearish, and in the case of crude, once again, 3 clusters of bullish, right? And let's take a look to see what the actual moves ended up happening in each of these futures markets. Also, we said we take a look at gold futures, right? So in the case of the S&P futures, we saw that we were exceeding normal volatility. In the case of the gold futures, we were still on our aggressive volatility box. We hadn't even gotten signs of exceeding outside of the aggressive volatility box clouds, but instead we were bouncing nicely from these levels. However, we're looking for not only a hit of this level, but then an edge confirmation signal on a 3-minute chart. This first entry, not valid for us, right? We didn't get that signal and a retest at that same price or better. Then the short entry right here is where you did get that opportunity, right? You had your first volatility box entry, which is an edge where we slammed into a zone. We now know we have an edge. Let's start to look for a signal. We get the signal right here. Any price better than our cyan dash line to play that same trade is the one that ends up becoming your valid signal to participate in the gold futures market, where you had a nice flush move down lower. Now let's take a look to see what actually ended up happening. Right, so if we go back to the S&P futures chart, we'll go back to our conservative volatility box. We had a really nice move up higher after that same cluster of 3 signals, not only into the rest of the day, but also into our close. And that's where we then started to chop sideways, right? And we'll notice the same pattern ends up becoming true on the NASDAQ futures after the cluster. Really nice move up higher. Even the Dow ended up catching along, right? We had that third signal finally populate and then a nice move up higher. The Russell, very similar, nice move up higher. And then gold gave us a nice move down lower. Now let's move on to Friday's activity to take a look to see how that is different and what we could learn from Friday's activity. Right, we'll repeat the same process that we did with our Thursday, which is we'll start with our volatility box on the aggressive volatility box, and we'll draw that line in that first hour chart to see what volatility looks like. In the case of the S&P futures, we breached far outside of the aggressive volatility box and we didn't bounce. And this should be a very clear, different picture than even Thursday's activity, in which we did bounce in the bearish direction, right? If we fix our charts, we did end up having that opposite direction. In the case of Friday, we didn't get even that. So that was your very clear first sign to switch on over to your conservative volatility box. Now, once we do that, here we see that while we did have a bounce, that bounce was not enough before price ended up falling back into our volatility box. What we were looking for was at least 5.5 or so points. 5.5 to 6 points is really what starts to give you the confidence that, hey, we're starting to hold what would normally be our trade in the S&P using the conservative volatility box. And this was your sign that, hey, the S&P really is starting to give you a bearish bias, especially after we break even our conservative volatility box to the bearish side. You then had plenty of opportunities if you are looking to play this as a trending move down lower. And a few of you have asked us how you can play this. The full size contract is honestly way too much risk. So you may be looking at something like the micros or using even options, right? Because with the micros, you might be looking at, say, a 20-point risk. And if you wanted to use even the pre-market high, more like 22 points to cover a decent amount of move for this fluctuation. And you see you did get a really nice move down lower, but it's the idea of how do you build a really nice trade around it that still fits your trade risk and trade style. Now, if we start to look at signs using our previous lesson, which is of a potential reversal, we start to see we had our first edge signal populate here, but we didn't really get a nice follow-through move there. But we started to get a cluster of edge signals here, and that's where you did get what would have been your T1 and a T2. Then you're once again on the hunt, and here you had your signal only populate. The only signal that was valid here was the long signal, and that was even outside of our conservative volatility box, right? And that's with this nice sharp move up higher. This is a Friday afternoon. Really, after this point, trading isn't something that I'm looking to actively do, and we can see what ends up actually happening, which is market activity starts to get really funky, and we're starting to break outside of the models. Then we have a cluster once again, we're starting to hold before a puke straight down lower, and really ultimately from where we had that first sign of, hey, we're starting to face greater volatility than usual, the market ends up falling almost 45 points on the S&P, right? And so that's how you can play a potential trending move, but this is on a really sharp trending day. We don't typically see a whole lot of these, but whenever we do, it's when we're breaking our conservative volatility box without even seeing this sort of a follow through. Usually what ends up happening when we get stopped out, or it's a sign, it ends up being later on in the day when we're getting stopped out on trades rather, as opposed to a very clear cut sign before we've even had to put any dollars at risk that, hey, the market's starting to break down, right? And so this is the final observation of this video, which is a failed follow through compared to what we've seen, which is a straight sharp move down lower, in which oftentimes then we have that V bottom, like Thursday's activity. In this case, it was a little bit more systematic, right? We tried to get a bounce, but it was a failed follow through of at least 6 points, right? The buyers here couldn't really get the market up above what the sellers were willing to push down on, and we see that really the sellers ended up winning in terms of winning 6 points from what would have been our entry, right? It's almost like a bidding process if you think about it. It's who wins higher from what we consider to be our turning point, our edge. Is it the buyers where we get a 6-point move in the positive direction, or is it the sellers where we get a 6-point move in the bearish direction? And here we see the buyers tried, but really failed, versus typically we see that the sellers just straight win, and then the buyers come in rapidly at the end after we've already been stopped out on the trade. That's what we're trying to avoid, and this is that sort of last potential hint. It's the idea of a failed follow through compared to a straight follow through on the way down. right? Something where the buyers actually tried, but then failed, trying and failing, as opposed to just failing right away. All right, hopefully this video helps you, this breakdown in terms of what happened in the markets. If we finally just conclude with looking at gold, and this is the last point we talked about in terms of having a swing trade entry, gold was using our aggressive volatility box, right? Our first hour gave us all signs that, hey, we're okay to use the gold aggressive volatility box market. We start to look for volatility opportunities to participate. We get our first signal where price is breached at the edge of an hour, but our signal comes in, our edge signal comes in a little too late because we've already hit what would have been our first target. So no valid trade here. Then we hit our volatility box right here. And this is the first trade which starts to become valid. And it's before we've hit our follow through, which is we get our first edge signal, then our retest of what is that same price level, which then makes this now a valid trade, right? Because prices started to chop in between. And we're starting to now see once again that same cluster start to form here. Now in this case, we're getting 1, 2, 3, 4, 5 arrows before price ultimately ends up shooting higher into the close. And if we bring this on a daily chart, what you can start to notice is you have a really nice move that's starting to look like a slingshot up higher. And if we layer in, say, the squeeze, then you can notice that we even have a nice squeeze that's starting to form, right? And so it's the idea of how our day trade entry right here, for those of you that are trading even more than 2 contracts, and this is where, again, the micros start to become really powerful, or even GLD or GLD options. It's the idea of then being able to play a larger swing trade move off of what was our risk right here, which was a very well-defined trade of an entry at the cyan entry line, stop outside of a volatility box. And we're now looking to see how high is high and using this trade as really your means to now really have a break-even stop point, and it's a free trade, right? You got to participate in this because you had an edge at the edge when it mattered. All right, hope this video helped. Hope pulling out some of these observations helps us to become smarter traders because it looks like this volatility is around to stay for even this upcoming week. All right, take care, everyone, and enjoy the rest of your weekend.